Okay, hello everybody. This is a supplementary video to sort of round out the material that we did not get the chance to cover in class on Thursday, the 6th. So we're going to cover the rest of it. Chapter 10 dealing with long-term assets, primarily property, plant, and equipment, and also intangibles. We're going to talk a little bit more about some of the whether we treat intangibles, whether we capitalize these as we often do, or whether it's in the case of R&D expenses, whether we just go ahead and expense them. And I think where we left off last time was talking about donated assets. I think this is the sort of the very last thing we talked about. And just to sort of round out and just to sort of pick up from where we ended on Thursday was we were talking about differences in standards between our GAAP standards here in the U.S. and the international standards. And both, will value those assets at the fair market value. The main difference here is, and that's obviously a debit on the a debit account. It's an asset. The big question is how do we treat the credit? And in the U.S. and the GAAP system, we simply report it as revenue, and it sort of meets the characteristics of revenue as defined in GAAP, and that is an inflow of an asset in the normal course of doing business. And obviously, that's not necessarily accepted. Well, it's not accepted in the international standards. And they would actually take the amount of the grant down and reduce the value of the asset itself. So if you have a $20 million project, $5 million is provided as maybe donated land or infrastructure, that $5 million would be deducted, and that's simply the way that that's treated. Or it could be treated as a liability, as a deferral, and I think we covered this a bit last time. And we would simply recognize that over time through amortization over the useful life of the asset, however long that asset's life is. And so I think that's where we sort of ended up last time. And let's sort of go forward here and talk more about where we sort of ended up. And in this example, we have under the international standards, we have the County of Santa Clara gave a parcel of land to the 49ers. I'm assuming that's the football team as part of an agreement requiring them to construct a football stadium on the donated land. The land cost the county $12,800,000 when purchased several years ago, had an appraised value of $20 million when the deed was given. $20 million, if it's an appraised value, that's a fair market value. Now remember, we're treating these exchanges of assets at fair market value typically. So the question is, as a result, how should we record this? And there's only one answer here that really works, and it's really the simplest answer, frankly. And it's basically this one, that it's going to be at $20 million. It's going to be valued at. It's going to be a credit to revenue of $20 million. And so debit the land as an asset and credit revenue, and that's simply how we would do the recording in the GAAP standards. And so nothing terribly complicated about that. Not that these agreements are not complicated, but the journal entry here is not all that challenging. Okay, and then there's a piece about capital budgeting, and this is just a very little tiny bit of this, and I really don't want to spend a lot of time on it because it sort of gets us into finance. If you've ever taken a finance course before, and usually they start at around 300 levels, so I would presume most of you have not. Some of you may have, particularly CPA prep students. There's a concept that's very integral to project financing known as net present value, and it's simply the difference between the expected value of cash flows, both in and out, discounted back to the present. And if they exceed the initial acquisition cost, then the green light should be given to the project. Even if it's $1, you may think $1, it's not very big. And no, it's not. But the idea is that this covers all the costs of acquisition and development and all that. Having said that, I know this is sort of a textbook answer. If it's $1 of net present value, would you do the project? And I know I was talking once to the CFO of the company I used to work for, and he said, "Yeah, I know that's what textbooks say, but if it's $1 and that's the best we can do, let's keep looking for other projects because it also assumes that there's a lot that's taken for granted. First of all, these are estimates of these cash flows, and something could go wrong. Typically, a lot of things don't turn out to be as well performing as what we think going into them. We have cost overruns, we have delays, we have all kinds of things, and so that's essentially what's going on with net present value. It is a discounted cash flow model, and we use this a lot, not only in finance but also in accounting and other areas. And some of this will come upon later. We already talked a bit about discounted cash flows, particularly the present value table that we looked at. And remember, if you want to know how to get to that, it's in the e-text. Just go all the way down to the left scroll all the way down, there are appendices, and there's one that has present value and future value tables. They're not the best I've seen. They kind of cut themselves off at some point, but you can find numerous numbers of those, online or whatever. You can use a financial calculator, or you can simply do the math. The formula's there, the formulas are given there, so you can take a look at that. So then there's I know that part of this chapter has some one-off topics. One of these, another one that, since we're talking about fixed assets, is fixed asset turnover ratio, where you're talking about how, on average, how much does a dollar of asset generate in sales? Higher the better is the common wisdom here. And when we talk about average anything, we could do, and we've come across this before. And remember, if you took 2120 here, which is Intro to Managerial, we had a section in Chapter 10, which was really, it really belonged in 2110, Introduction to Financial, but we wanted to sort of even out the chapter, content in each, and so we sort of cover that as the first topic of 2120. It's simply the beginning anything plus the ending anything divided by 2. That gives you the average. That may or may not be the right way to do it, particularly as I think I mentioned this earlier, with things like receivables turnover. What if receivables are very low at the end of the accounting year? Remember, the end of one accounting year becomes the beginning of the next accounting year. Maybe the seasonality is such that you have a very low receivables number. So that may not be the way to go. You could take, I've seen companies use every 15th of the month, add them all up, divided by 12. Divided by 12. You could, with computers, it'd be easier to take an ending value every single day if you wanted to do that. If you have the capability, divided by 365, that would give you a much more accurate number as to the turnover ratio. How useful this is, I suppose, really depends upon the kind of business that we're talking about. I think probably it kind of ties into inventory turnover in some ways. I know the examples that we're going to use are of merchandisers, and a big piece of the asset base to merchandisers is inventory. And so in this example here, we've got two different retailers, Gap and Ross. This is not Gap as in generally accepted accounting principles. This is the company, The Gap. And so as a result, you've got, by the way, this should be 2018 because we're keying off of sales for 2018. And so what are you doing here? So we're going to take asset turnover, which is basically total property, plant, and equipment divided into net sales, or net sales divided by property, plant, and equipment. Well, same thing. So if you're taking the average, so 2805 plus 2616 divided by 2 is 2710. So you're going to get a figure of 585. Typically, this is a number. You can put a dollar figure on it, and then you could say, well, for every dollar of assets, we generate 585 in sales. Okay, that makes sense. Again, the higher the better, theoretically, because it shows more efficiency at generating sales off of assets. It makes a lot of sense, like a lot of ratios that we do in accounting and finance. Comparing one company to another, particularly a close peer, is useful. And so in this result, we have a different sales level, pretty close, 14,135,000, and then we take 2382 plus 2328. Obviously, we're adding zeros to all of these. Then divide that by 2, you get 2,355,000, and you're going to get a $6 or 6 ratio, which means that Ross is a little bit more efficient at generating sales per dollar of asset. I don't know how useful this is in real life. I know that I've done a lot of ratio comparisons over time as a credit analyst and whatnot going forward. And I don't know how useful it is, but you get the idea that generating more dollars of sales of assets for a dollar of assets is better than having fewer dollars of sales per dollar of assets. And so in this case, we have another example. Hubert Corp and Winslow reported the following information: calculate each company's fixed asset turnover ratio. Well, the same methodology applies. We're going to same sales, okay, 1850 and 5120, and we're going to take the average of these. So the math here is going to be simple on the denominator. That's 210 plus 220 divided by 2 has got to be 215. It's right in the middle. And this is going to be 665. It's right in the middle between 680 and 650. So if you do the math here, and it's shown on the next slide, you're going to get the ability to make the comparisons. And let's just kind of do this. It doesn't really take too long at all to do. So again, your 1850, which is the sales figure. I'm assuming we're chopping some zeros off of here somewhere. And you're going to get 8.6 as a asset turnover for Hubert, and it's going to come out to 7.7 for Winslow. So if these are close competitors, then you can make a comparison as to the efficiency of management or or whatever kind of measure you want to make. Also keep in mind too that we not only do we do peer analysis from one company to the next, and companies themselves do this to compare themselves with their nearest competitors, but also against industry average as a whole, for that particular industry, whatever it is. And we don't really know what industry this is. Obviously, Gap and Ross are both clothing retailers, and so you would simply use that as a comparison as to whether or not it makes sense for that. And by the way, this is shown here as a number, not as a dollar figure. And when I've seen this ratio, it's usually not expressed as a dollar figure, but you can imply that it's $8.60, $7.70 of sales per dollar of assets, and so, or fixed assets. And so it kind of gives you an idea as to what's going on. Now, notice that when we talk about fixed assets, we're not talking about inventory here. So it's interesting that they use retailers, because you think as I mentioned a minute ago, a lot of the asset base is inventory. So it's kind of interesting that they used a merchandiser here. What is probably a little bit more realistic is to use businesses that have lots and lots of fixed assets: airlines, manufacturers, real estate companies, hotels, things like that have lots and lots of fixed assets, and then it really starts to become meaningful. And I'm not being critical of the text. I'm just simply saying that in reality it might be a little bit of a better example to have used some other industry. But nonetheless, the point is hopefully the point is made as to how and why that particular measure is used. Okay. All right, so let's talk about exchanges here. We're talking about one asset being exchanged for another asset, sometimes involving cash, sometimes not involving cash, although typically cash is used to sort of plug the value, because remember, this goes back to introductory economics. What is one of the values of money? It's as a medium of exchange. Otherwise, you run into the barter problem where you've got to find some party that wants what you have, and you've got to find what they have just coincidentally. And you've got to somehow agree. And, with no monetary plug number, it becomes difficult. It's difficult enough just to find, the coincidence of wants anyway. But it does happen. And there are cases in which assets are exchanged between firms, particularly in the same industry. And I think I've seen it in real estate where a company will exchange certain acres in this area for a number of acres in some other area. And there's a way that you can do that. But oftentimes, they don't agree on the same price doesn't apply, because we're talking about the fair value in both cases. The fair value of the current asset, notwithstanding that the book value may differ. In fact, the book value may differ substantially. And this is something I think we have to keep in mind always, is the idea that book value has sort of got some inherent limitations. And one of those inherent limitations is the valuation issue. So in this case, you're exchanging old value, trading it in, or for whatever, some new asset, but it doesn't be traded in. I mean, when we say traded in, it makes it sound like we're trading in one vehicle for another vehicle or something. That could be the case, and that often is the way things are done. But it could be any kind of exchange where we're looking at exchanging one asset for another, and then making up the difference in cash. There's often going to be a gain or loss that's recognized, and so we'll see some examples here. And so the steps in recording it are not particularly complex. First of all, you're going to record the new asset at fair value, as we always would. Even if we were just doing an outright purchase, we would record that at fair value. Why do we know it's fair value? It's because we're willing to pay for it in an arm's length transaction. So that becomes fair value. That becomes the cost, the historical cost of the asset, based upon whatever the fair value is. We take the old asset off, but we have to take the book value off, because it's being carried on the books at book value minus any accumulated depreciation. And remember, when you dispose of an asset, and I think we talked about this a bit before, when you dispose of an asset, that one that's got accumulated depreciation, you have to take out the asset, the debit, but also take out the accumulated depreciation, the credit, which is the contra asset to that. They both have to go because they're no longer applicable. They're leaving the books. And then any kind of cash received or paid is, depending on where you are in the transaction, as to the market values of these two goods. And then any gain or loss is recorded. Gain typically is going to be a credit balance. A loss is going to be a debit balance that balances out the journal entries. And so let's see, I think we've got a couple examples here to show what's going on. So the Elkhorn Company traded and sold laser equipment for the newer laser equipment, and the old equipment had a book value of 100,000. This is the equipment that's going away, and a book value of 100,000. That's 500,000 minus the accumulated depreciation of 400,000. and a fair value of 150. That 150, as compared to the book value, is going to be relevant here. And then the company also paid $430,000 in cash as part of the exchange. That's the majority of the transaction, but they are disposing of the asset. Well, the first thing you've got to do, well, first of all, you're going to put this on the book value at the fair value. But in this case, we also have to know, first of all, how do we get to that? Well, the 400,000 is the original, is the accumulated depreciation, which is a credit account. To get rid of the credit account, you're going to do a debit, get rid of it. The asset account, which is carried on the books at 500,000, and we have to credit that to get rid of that. We're also paying 430,000 in cash. Remember, we're taking this from the standpoint of Elkhorn, the buyer, and we have a gain, and the gain is 150,000 fair value minus the book value. And so as a result, we sort of back our way into what the value is. Now, it's not just some coincidence that we get there. We didn't just arrive at this number in necessarily the way that I got to it. The 430, in reality, the negotiating process presumably would say, okay, we'll take your asset that's worth 150,000 and pay us 430,000. So obviously the seller and the buyer are both aware what the value of the new equipment is going to be. So it's not like 430 is just some mysterious number. It was arrived at ahead of time, presumably, and presumably we've got buyers and sellers who know what they're doing. Okay, so that's an example. We have a gain. Again, a gain. It makes the journal entry balance, and again, it's not any secret as to where 50,000 came from. It's simply the difference between the fair value of the old equipment and the book value of the old equipment. Okay, and so where we carry things on the books at cost minus accumulated depreciation, if any. In this case, we do have accumulated depreciation, which brings the book value down below fair value. And again, book value and fair market value are often different, and it's one of the peculiarities of GAAP accounting. But then again, as I've said a couple of times before, historical cost accounting has got its passionate advocates who advocate really against booking or carrying things at fair value. We carry some assets at fair value, but we'll talk a bit more about that a bit later. Here's the same scenario, except for now the fair value is less than the book value. So now we have a loss of 25,000. All the facts are the same. Still 430,000 is cash paid. So the terms of the transaction are the same. The only thing that's different is the where the book value of this asset is now in relation to the previous scenario, and so the fair value is less than the book value by 25,000. So again, a loss would be a debit balance, and that's how we would make that journal entry balance. Every entry has to balance, of course. Every journal entry has to balance, and so as a result, this is how we get those to balance. Okay, depending on what the scenario is, and it's a very common transaction. And I don't mind the idea of using the trade-in example. I think it's one that we can all sort of relate to. I trade in something old for something new, and I can also bring money to the table in order to do it. And so it's not an unusual scenario at all that this kind of thing happens. Okay. All right. And then what about when the fair value is not determinable? And in this case, we don't really know. Now, one of the things that we should mention is that, and we said this at the outset when we were talking about the acquisition. Remember, Chapter 10, when it comes to PP&E, is about acquisition value and how we book these. And we said that either we take the fair value of the asset being acquired as the value that we carry it as what that transaction is worth, in other words, or the value of the assets given up. And if it's cash, well, that's pretty simple. But sometimes we don't always know what the value is, and so we sometimes have to use our best judgment. So in this case, the fair value of both the new and old equipment is not determinable. We don't really know what the fair value of those are, and so as a result, what we're simply going to do is we're going to still do the same entries to reverse the equipment and the accumulated depreciation, and again, we're simply saying that we're going to pay 430,000 in cash, which means that we have a debit balance on the new equipment at 530,000. Now, is that a common scenario? I don't really know that it's all that common that we wouldn't know what something is worth, but I will say, and maybe I'm not seeing it as clearly as what is the case, but I mean, there are assets. I will have to say that they're really difficult to value, and I think I mentioned this in a previous video that we certainly saw this during the financial crisis, where there were assets that were just really difficult to value, and so it became really hard to sort of put a number on. And so there are these occasions when this happens, particularly if we're talking about very unique pieces of equipment that really don't have an identifiable market value. It's certainly not a quoted price. that we can look at. So it becomes a little bit more challenging to do that. Okay. And another thing here with regard to how we recognize gain or loss, the transaction itself is meant to have commercial substance. And what this means, this is sort of a theoretical accounting issue, and that is that if somebody's going to acquire a new asset, they should be doing it in order to improve cash flow, which means either maybe it helps to improve revenue, lower costs, it's more efficient, and whatever. That it should not be done just in order to incur a gain. Although I have to say that, a lot of times financial analysts are very sophisticated and know that if they don't like the way the treatment has been made, they can certainly back a gain out. I don't think anyone's being fooled if you recognize a gain. A gain will make its way down to net income, not earnings before interest, taxes, depreciation, amortization, so-called EBITDA. But I don't think too many people are fooled. But nonetheless, this is part of the issue. And so if it's a gain situation, the book value is used to record the exchange. If it's a loss, then the fair value is going to be used to record the exchange, but a lot less common of a situation. The whole issue here is to really prevent against gains treatment, gain recognition where it should not be the case. And so in this particular case, the Elkhorn traded a tract of land to Sanchez Development for similar tract of land. Again, I have definitely seen exchanges of land between developers and whatnot. It happens somewhat frequently, maybe not every day, but it happens somewhat frequently. So the company paid $500,000 in cash. The old land was worth $2.5 million, but we're not going to book the gain here, even though it has a fair market value. The new land, the old land has a fair value of $4,500,000. If we booked it at fair value, we would recognize a big gain. There is no gain recognized here, and so the idea is that it's deemed to not have commercial substance, and it's all it's really trying to do is to sort of avoid this idea of churning assets in order to generate gains on what are long-term assets, on what are meant to be long-term assets. And then you can take a look at this. This is a fairly lengthy slide. It's also in your text, also in the slide package, but it sort of summarizes what we just talked about with regard to exchanges. First of all, the transactions, the steps in the transaction, and then whether it's got commercial substance or not. Most transactions, I think, would probably be deemed to have commercial substance. I don't know that it comes up a lot. It probably comes up a lot more in tax accounting than it does in financial accounting. But that's a whole other can of worms that we're not going to get into here. So you can take a look at that and ask me. If you have questions, you can feel free to get with me. Okay, a quick concept check. Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000, fair market of $75,000 for the newer model of laser equipment. In addition to the old equipment, $90,000 in cash was given. So Arizona should recognize, well, okay, if the fair value exceeds the book value, then we're going to have a gain of $5,000. And so that's what we're recognizing is a gain of $5,000. Okay, not too difficult of a situation here, and we're not given any information that it's not a transaction without commercial substance. Another scenario, Arizona Pharmaceuticals. Well, it's the same scenario. Arizona Pharmaceuticals exchanged laser equipment, all the same facts. In addition, $90,000 in cash was given. Arizona should record the new equipment at what? Well, okay. So what are you going to be doing here? The answer is going to be $165. Why? It's going to be the fair value of $75 plus the cash of 90 gives us $165, and it becomes the cost basis of the new asset. Remember, we're booking assets. Acquisition of assets is booked at the fair value. Fair value is considered to be $75,000, and $90,000 cash was given. So this is the booking of that transaction. Okay. All right. Let's move along here, and hopefully I'll be able to get all the way through the rest of what we did not do. I've said this before, but it's difficult in intermediate accounting. There's just so much going on. It's really in depth. We just don't have enough time to sort of gallop through it. But I do want to cover things just in case you benefit from that. So let's move to self-constructed assets. This is not an unusual scenario. I think when you think of self-constructed assets, you think, yeah, it's a builder building a building for themselves. Well, yes, that's certainly true. It's not only that; it's any kind of company that would construct an asset, and they essentially handle, the details of putting that asset together. And it could be any kind of a long-term asset. In this case, buildings. It could be displays, whatever, they have a long-term life, etc. So rather than buy one out of the market, they're going to put one together. And so the two big issues here is, number one, any kind of indirect costs, such as overhead, that are allocated. There are really two different methods by which this is done. One is the preferred method under GAAP. The other is more of a theoretical sort of a judgment call. And the other is, how do we handle interest? And there's quite a lot in this chapter about capitalized interest and what we do about it. And so I'm going to urge you to really read this section quite carefully, because it's going to be important to really understand what's happening, and just maybe look at it. And I know this is one of the areas that I can even remember back in my day as an undergraduate. I thought, wow, I'm not really getting this. And it was a kind of a deal where you might have to read it, let it kind of soak in, go back and look at it again later, just to kind of get the feel for what's going on. And it really has to do with the idea that there should be interest incurred in order to produce a self-produced asset. So we'll talk about that. We talk about overhead allocation. One is only the incremental overhead cost. That is that which is incurred as a result, the difference between the current overhead cost and that which is incurred, which is attributed to the project itself, which seems to make sense. However, the full cost approach, which is more comprehensive, is really preferred under GAAP. We're going to talk a little bit more about those, I think. Interest capitalization. When we talk about capitalizing anything, we're talking about putting that thing as usually it's an expense that we're capitalizing, and then and if it's a long-term asset that is depreciable, then we're going to take that and depreciate it over time as part of the cost of that asset. And interest is one of those costs, and we have to use actual interest, even though some of the interest may not be directly applicable in the actual transaction. We'll talk about what's going on here. So what are we talking about? We're talking about assets that are constructed for a company's own use, and also those that are specific projects that they intend to later sell. So that is going on. Also, there's interest. That's only the interest incurred. We can't impute the interest here. It sounds like we are, but we're not really, because we can't exceed the amount of interest that's actually incurred. That really wouldn't make any sense. And then the period of capitalization begins when it starts and then ends when it is finished, and which is pretty simple. But we'll talk about how it gets a little bit challenging. And then we take what's called the average accumulated expenditures approach, where we're simply taking different amounts of expenditures and we're time weighting these. And so if you have one expenditure on January the 1st and it's a 12/31 year end, then that's going to be all 12 months of the year. If it's done on July 1st, that's going to be 6 months of the year. So you're going to sort of weight that, depending on how much time that expenditure is out there for that particular project. And it's also going to have a lot to do with interest itself. So here's an example. And this is one where it's an 18-month project, Mills Conveying, began construction of a building to be used as headquarters. It was completed June 30th of the following year. So we have these expenditures at the beginning of the year: January the 1st, $500,000, March 31st, $400,000, September 30th, all that same year, $600,000. So altogether, $1.5 million. And then the following year, we had another $600,000 on January the 1st and another $300,000 on April 30th. So kind of maybe you might want to kind of flip back to these if you like, just to kind of reference these particular dates. January the 1st which is the beginning of the period, construction period, the company obtained a $1 million construction loan with an 8% interest rate. The loan was outstanding during the entire construction period, in other words, 18 months. We're going to take 1 year at a time here, though. And the company's other interest-bearing debt included two long-term notes of $2 million and $4 million with different rates, 6% and 12% respectively, and they're both outstanding during the entire construction period. So, all right, so let's get at this. I know this may be a little bit small to see because I know they've got it kind of shrunken down there, so I'll try to make it as big as I can. Even though this scenario, I think the name of the company may be different in the text than this scenario, but I think the numbers and everything are all the same here. So what's going on? The time weighting example says, if it was done throughout the year, right, $1.5 million, and there was, at various points in time, you can simply divide that by 2. That would be the average, beginning plus ending, ending being 0. Beginning being 0, ending being 1.5, divided by 2 is 750,000. Okay, that's not typically what happens, and it's probably not the most rigorous way to do it. Instead, let's just take the actual facts. And then we have these expenditures in 2021. On January the 1st, which was all year, 12/12 of the year. March 31st, which is 9/12 of the year. September 30th, 3/12 of the year. So you're taking these dollar figures, multiplying by these fractions of a year. This is how we time weighted. So we get these weighted expenditures. So it's 500,000 all year is 500,000. 400,000 for 3/4 of the year is 300,000. A quarter of a year of 600,000 is 150. So total expenditures in that first year are 950,000. Okay. Those are the expenditures based upon the average length of time these were outstanding, okay, throughout the year. We have to keep good records and all that. So remember, the construction loan was 8%. So 950,000 times 8% is $76,000. And so we do well with that interest. We capitalize it on top of that, on top of those costs. On top of that 1.5 million, we're adding 76,000 in accrued interest that we're going to capitalize as part of the cost of construction. Okay. And even if, and we'll get to some examples of how we take other debt into account, and the idea being that, whatever source of funding is used, the theory is that oftentimes interest should be implicit in the transaction itself. If there's other debt outstanding. Now, we can't capitalize more than what's actually incurred by the firm, but it is implicit in that sometimes companies sort of jumble together their financing, especially a lot of long-term financing, and it becomes sometimes difficult to sort of attach it to individual projects, particularly when they got lots of different projects going on. And we'll talk about why we're doing this, particularly when we take other debt into account. Remember, they have debt at 6%, I think 12%, and we'll get to that in a second. Okay, so 1.576 million at the end of December 31st. That's the carrying value of this particular good in process, right? It's construction in progress. It is an asset, and we're putting that accrued interest into it. Okay. Okay, and we're going to compare with actual interest incurred. So remember, we had 80,000 actual interest during the year on the construction loan, but and so it was out for the entire year. Okay, we also had 2 million at 6%, 4 million at 12%. That's what I mentioned a minute ago. So we had total interest through the year on these three obligations of 680,000. But we're going to go with a lower amount. It was 76,000. That's the amount of interest that is associated with the time-weighted expenditures on the asset itself, the building, okay, at a rate of 8%. And so that's the amount that we're going to add onto that. Okay, but we have to do the comparison because it's not always going to be the case. And so of one being greater or less than the other. And we're going to start in 2022 with the same thing. Remember, 2022 is the second year of this. And we're going to do the very same thing. And when we talk about something called the specific interest method, we'll talk about that versus the weighted average method, and the same procedure is done. But let's get into this the issue of the weighted average method. Okay, the specific interest method is one thing. That's one particular method. It's something you should know, and you would just simply do the same thing for 2022. Okay, but if we take the weighted average of all debt outstanding, and we're assuming is outstanding the entire year, that was the scenario given to us, and so we have 1 million at 8%, 2 million at 6%. All the way across. And so this is the actual interest expense, 680,000 for the firm, divided by its interest expense, divided by 7 million is going to give us a weighted average interest rate of 9.7%. That is a weighted average cost of debt, or cost of long-term debt in this case. There are different times in which we figure that weighted average cost of all debt, but we're not worried about that here. We're going to take 9.7%. As because remember, sometimes companies sort of jumble up their financing. It's not always possible to take one bit of financing and put it together. So that would be the amount that we are using here. Okay, and we would simply apply. And so instead of using 8%, we'd apply 9.7%, and that would be the rate that we would use if we take the weighted average method. Both methods are used, and both are acceptable. At the end of the day, I mean, it just becomes the construction costs are going to include interest as well as the actual costs themselves. And so they all become part of the cost of the asset. Okay. Your text also talked about the need for disclosure, oftentimes in the notes. One of the things that I think differentiates among a lot of other topics, actually, intermediate accounting from intro financial is the idea of emphasis on notes to the financial statements. And I can't tell you how important they are. If you're an avid user of statements of companies, particularly public companies, you're going to dig into the notes. You're going to find out what's going on, and they tell a big story. And I know that they're not easy reading for the the uninitiated. So I know that. But for those who know what they're looking at, it tells a big story. So in this case, I presume this is actually from Walmart. Interest costs capitalized in construction projects were all this in these years respectively. And sometimes they would go into more detail than that, but sometimes companies are fairly oblique in their notes to statements. And if people are really terribly interested in what's going on, they will they can contact the company and try to get answers out of them. There, a lot of most public companies have an investor relations department that can answer those questions. It's probably easier to get to them than it is to the CFO or anybody in that particular area. And maybe you'll get an answer if you really, really want to know what's happening. Also, public companies have quarterly conference calls, usually very well attended by analysts, and sometimes there are things analysts just don't understand. They'll ask questions. And again, to the uninitiated, it's probably not great entertainment necessarily, but it is informative to users. And again, all financial accounting is geared for the benefit of external users. Okay. All right. So here we have a quick question dealing with specific interest method, and you just kind of got to follow along what's happening here. You've got same. Looks like the same dates here, but only it's different numbers and different company. January of 2021, the Mateo company began construction, and we had these costs. 13 million were incurred based on the schedule: January 1st, March 31st, June 30th, October 31st. I guess the dates are different here. And they took out a $4 million 10% construction loan at the beginning of the year. The company had 20 million in other interest-bearing debt with a weighted average interest rate of 8%. The facility was completed early in 2022. What amount of interest if they're using the specific interest method? Well, if you're using the specific interest method, you're going to take this time-weighted expenditure, and then you're simply going to compare that to the amount of financing. So here we have the average expenditures were $7.5 million. Now the total expenditures, oops, went too far. I went way too far. Oh my gosh, okay, sorry about that. Yeah, I went. Sorry about that. I got a little crazy there. I think I made this too big, and I'm trying to make it so that you can. Okay, there we go. All right. So the average expenditures were $7.5 million. That wasn't the actual because it was 13 million. But how did we get to that number? Well, 2 million on January the 1st. That's all year. 4 million at March 31st. That's 9/12 of the year. 4 million halfway through the year. October 31st, and we have 2/12 of the year. So as a result, that gives us 77.5 million. Capitalized interest, and remember the loan was 4 million at a rate of 10%. And so as a result, we have that plus the 3.5 million at 8%. And as a result, you get a figure of $680,000, okay, as the amount of capitalized interest. So it's 400,000, 4 million times 10% is 400,000. 3.5 million times 8% is 280. So as a result, we get 680,000 under this particular method. Okay, and that's where we're taking this time-weighted expenditure, and then we're sort of using that to compare against the actual interest. Again, we can't capitalize more than what's actually incurred, but that is the way to do it. Okay, as opposed to simply using a weighted average method. Okay, if you keep good records, and a lot of companies do, and that's a preferred method. It certainly is a method that a lot of intermediate textbooks emphasize a lot, and it seems like it's always a question that comes up in quizzes and work type situations. Okay. All right, so let's talk about R&D. R&D is an interesting topic. There's a lot here, but it goes fairly quickly, I think. And it's not and again, I before I get into R&D, I want to encourage everybody to look at that interest capitalization very closely. It's the textbook gets into these situations. It gets pretty detailed. Just make sure you're familiar with what's going on. You can follow where all the numbers are coming from. And if you don't know where they're coming from, just maybe step away, come back in a little bit, take another look. And I guarantee you, having been at this for a long time and having done my share of college courses myself, sometimes it's better to step away and come back, and then things become a little clearer. And if they're not clear, well, then I'm here, and feel free to reach out. I'm more than glad to talk with you. I'm here pretty much every day. I also am available by Zoom. And if that's easier for you, then I'm more than glad to do that. So, okay. Let's talk about research and development. And here it's interesting they divide research from development, and it's something that I think a lot of us sort of think is R&D as being one thing together. They're simply splitting these two out and saying research is basically the scientific or the research, trying to develop some new idea, some process, some product, some formula, whatever the case might be. And development is more about how you monetize it, how you make a product out of it. It's one thing to come up with some new finding, but what do you do with it from a business standpoint? So, and this is all prior to the product hitting the market. And when we talk about R&D accounting, we're talking about a lot of different costs here, including salaries and wages is oftentimes a very big cost, particularly if you've got researchers who are hard at work trying to come up with things like new drugs and new materials, and certainly in the technology space, people are hard at work, but also things like materials that are used, any kind of equipment costs, and we'll talk about equipment more in a second here, any kind of intangibles that are used, particularly those that are acquired, and we'll talk about that in a second, and then any kind of other services that are performed. And when we talk about an asset for a single project, then we're going to consider R&D, and we're going to expense it immediately. Now, this differs from an asset that can be used for multiple projects, particularly if it's an asset like a building, for instance, or a lab or equipment or computers or whatnot, that maybe they're dedicated to a specific research project, but at the end of that project, whatever happens, sometimes they leave it nothing. And that's part of why the accounting treatment is the way it is. At the end of that termination of the project, whatever happens, some of this equipment can be used again, or buildings or whatever can be used again, in which case they're not treated all that differently than regular fixed assets. And so we have to understand what's going on. So otherwise, they're expensed in that current year. And I know that sounds a little bit different than what we've done before, but it kind of ties into what the whole logic of R&D accounting is about. And by the way, this your text notes it's controversial. I would second that. It's one of the areas it's been people have been complaining. I guess companies, I should say, have been trying to lobby FASB for forever. I mean, as long as I can remember, to try to have different treatment of R&D by saying, look, you're actually mismatching expenses and revenues when you do this, because we may invest, I don't know, $200 million to come up with a new drug, and it takes us 5 years or whatever. So we're creating all these expenses in these 5 years, and we're not matching those to the revenues that flow out of them. The problem is there are a lot of difficulties with trying to match up revenues against the expenses that are involved in R&D expenses. And this may be one area where no one's happy, but FASB takes a cautious approach here. And I get it. I understand why. A lot of R&D never becomes anything. And how would you know if it becomes something? And by the way, you may create some product or process, and you may even create a product out of it, but then the product may have competition, maybe becomes immediately outdated. There are problems with the product. We've seen cases in which pharmaceutical companies have come up with new drugs, and they're not very effective, or they're causing lots of problems. And so there are just way too many variables, and one just never knows what's going to happen. In particular, the big issue, it'd be one thing if we knew that all R&D created a marketable product that could be, after the development stage, could be set to market, and we could maybe deal with that, but it's just too difficult in order to do that. So during the R&D phase, these are basically expensed, most of these, with the exceptions of, and we'll get to talk about patents and whatnot, but for whatever reason, they sort of lump the patents in here as sort of an intangible discussion, which we'll get to, but it's not really R&D. It's usually after the product is ready to go, and it's not treated any differently. But while the product is being developed, these are mostly expensed, with the exception of any kind of asset that's got a different use than just for the one particular project. And so that's essentially what's going on. Once the product becomes up and running, then we treat these costs as like we would any other, like engineering follow through, quality control during routine testing, and all these things are not R&D costs, and so they're not treated any differently. But we tend to expense these costs going into it, and so here's the example, and we're going to sort of carry this example for quite a bit here, but it goes somewhat quickly. Askew Company made the following expenditures during 2021 related to the development of a new industrial plastic. Okay, so you've got salaries and wages, and I said that's usually a very big one. Any supplies used, purchase of R&D equipment, okay, patent and filing costs, 700,000, payments to others performed in connection. So altogether, it's 19,300,000. Now, what does the journal entry look like in terms of how we treat these expenses? And we're going to be sort of flipping through here quite a lot in order to just to see what's going on. So if we go to this, 14,200,000 is expensed in that year. Okay, and where does that number come from? It's the numbers highlighted in red. R&D wages, supplies. That's 13 million plus 1.2 million. For other services, that's 14.2 million, and then the credit to cash. In other words, cash out. These may not be all at one giant lump sum expenditure. These are aggregate expenditures that are recorded. This is the aggregate journal entry to record these. Okay, and we're going to take the same facts. We're going to talk about the equipment. We're going to talk about the patent and all that. But these are the costs incurred during this particular phase. And this is a pretty quick. I think they're ready to go up to like 1 year. Okay, so back to the original data here, original numbers. What about the R&D equipment? $5 million. Okay, well. We are going to put it on the books as equipment because it's going to be used in other projects. This is the key thing here. If the equipment can be employed in other projects, we're not going to expense it. If it's not going to be employed in other projects, we would expect to expense that in the year in which it was purchased, all of it. Instead, we're going to put it on the books as an asset, just like we would any other, and cash is the offsetting credit to that. But the key issue is it going to be used in other projects? If so, then that's the treatment for that. Then the same facts again, and we have a patent here, and this is the same thing here. I think this is the same issue. Oh, here's the patent, $100,000 for the patent, and again, the patent treatment is nothing that's different. But yes, it was part of the R&D project, but you wouldn't file a patent on a product until it's gone through the development stage, and then you would file a patent. And hopefully you're the first to the market on this, so you can actually get a patent. And the patents have value, and it's capitalized as an asset. Okay. And what kind of costs are we talking about? Legal fees are a big one, also any kind of filing fees, any kind of supporting documentation, the cost of all that. And as a result, this is and we put it on the books as an asset, and we would amortize it over the useful life of that, just as we would any other patent. So it's the termination. It's really sort of the terminal phase of the R&D, and then, but once the product was ready to go, there are still costs, and we would treat those as we would any other costs, and go from there. So as a result, these are so here's how all the costs together, 19,300,000. Okay, in comparison of GAAP versus the international standards, R&D costs under GAAP are really not treated too distinctly from one another. We sort of lump them together as R&D expenditures. There are a lot of companies that have lots of different R&D expenses going on. The drug industry comes to mind. They're always doing new development, and it's part of the lifeline, sort of the survival mode of operations for the drug company. Once the drug goes off patent, you've got a lot of competitors offering a cut rate price, and so the monopoly pricing power goes away. So they've always got things in the pipeline. This is why people who follow the drug industry are really interested in where companies are with their testing, and they've got to get a number of different phases they've got to go through in order to get approvals through the Food and Drug Administration in the U.S. and in Europe, it's a different process. But they are sort of lumped together. Under IFRS, they're expensed in the period incurred. However, there are some categories that are capitalized as intangibles, and what those are, we can get into this, but we want to introduce students to the differences between GAAP and IFRS standards, but I don't think we want to drill down that deeply into it. There are a lot of areas in which there are some differences, and the accounting is significantly different. But all we want to do is point out the fact that there are some differences that are going on. Okay, and under both GAAP and IFRS, all the patent costs receive the same treatment. Okay. All right, so we're getting close to the end of what we're doing here. There's just some different examples of different kinds of industries and different kinds of acquisitions that we want to talk about, particularly things like software and how we deal with this. Particularly, and we're talking about developing software and the point at which the concept of technical feasibility is reached. And once it's all ready to go, then the R&D stage is essentially done. we're capitalizing the cost up to the date of the product release, however. So, and this is a little bit different than the previous example where once the product is more, we know there's a product that we've got, we're still capitalizing cost as a result of this. This is often very expensive to produce this, and anything after that, the phase of the product being released is treated like any other cost. If there's an inventoriable sort of cost, you can include it. Software is kind of a strange product in the sense that it's a product. It's produced, it's marketed like a physical product. You really can't even call it a service, really. I mean, I know, which is not to say that there isn't this part of the tech industry known as software as a service, but it's really developed and marketed like a product, even though it's not of physical nature. And so it's a little bit of a different animal. And for a long time, it was not clear as to how we treat software. I think software at one time was simply treated as part of hardware. Of course, now we know that the two are very distinct, and that the software business is much more valuable than the hardware business, and of course it continues to improve, and that's even prior to the this explosion in artificial intelligence that we see happening. Let's talk about cloud computing. This is the area that I guess maybe 10 years ago we probably wouldn't have really talked about this very much, but it's used by lots of different industries. Cloud computing, there is no cloud. It's a metaphor for using someone else's servers. And so, if you're a business and you're running applications, you don't necessarily have to put them on your computer. You can actually just you can access, some other a vendor's service, whether it's Oracle or SAP or whomever, and use that. We certainly do that in the accounting world, in our tax practice. We used to download software to our computers. Today, we just simply we pull it down from the cloud. It's got a lot of advantages. We don't have to, the security issues are the vendor's problem typically. I mean, there are problems if there is a breach, but it's typically the vendor's problem. There's no real maintenance on our end, and any kind of updates can be done immediately, and or patches to the software. And so that's what cloud computing really is. Now, if both of these are met, then we treat it a little bit differently. That is, if the customer has a contractual right to take possession of the software, and I don't know how common that is. My experience, and I have not worked everywhere, so I don't know, but I don't know that that's real common. But the customer can run the software on its own or with an unrelated vendor. Well, that's not terribly uncommon. That was really the case before cloud computing became a thing. But if they're not met, then simply a service contract, and we create expenses. We would not put those on the books as an asset. So typically, cloud computing costs are just simply expensed as they're incurred, and why wouldn't they be? I mean, that's I don't know how you would capitalize it. I don't frankly know the answer to how common it is of number one there that the company can take possession of the software. That seems to be quite an obscure issue. It seems to even sort of negate the very premise of why cloud computing is even a thing. Okay, and then one final bit here. We're sort of wrapping up with some one-off topics, and among these, since we're talking really about intangibles, and again, intangibles are capitalized as assets, and we're talking about a case of R&D being done for others. And there are companies that do research for others. They could be subcontractors working for some bigger vendor where some of the work is being subbed out for them. And if you are that subcontractor, or your business is doing research for others, then you're capitalizing this inventory because that really meets the characteristics of what inventory is. You're producing a product for others. It's going to have future service value. You're going to deliver that to others. Whatever they do with it is their business, right? But if you're doing it for others, you're going to put them on the books as inventory, and you're going to carry it in a very similar sort of fashion. Okay, any kind of startup costs or organization costs and whatnot tend to be expensed in the period incurred. This is primarily for existing businesses that are just simply branching out into other areas. We would not capitalize those as intangibles, rather expense them. And in the case of purchasing R&D, this is sort of the other side of the transaction. If it's developed technology, we're going to capitalize that. And if it's got a finite life, it's going to be an intangible asset. It's going to be amortized over that finite life. So if you're acquiring technology or R&D from others, which is common, you're going to capitalize it as fair value, and you're going to amortize it. If it has an indefinite life, intangible asset, it's going to be expensed because, first of all, how do you know how would you know what period of time to amortize it over? It doesn't, it's too difficult to know. And there are assets that have an indefinite life, and so they're going to be expensed as incurred, as opposed to some limited useful life. So now, having said that, there are cases in which an asset can be impaired, which means you can write down, the value of these assets over time, particularly things like this, if it's got a finite life. If it is no longer valued at where it's being carried at, then you would have to mark it down. But that's another issue there. We don't talk a lot about impairments just yet. So, and we talked a bit about organization costs being expensed. And then the final bit here deals with oil and gas accounting. I don't think your text really gets into this much, and I don't know if it's in part of the appendix to this chapter or what. And it's not a huge portion of it. And I can tell you that we could do an entire semester on oil and gas accounting, even a couple of semesters on oil and gas accounting, another semester on oil and gas tax accounting. So, and there are a lot of different areas of this giant complex of interrelated industries. And the example I think we're using here is exploration and production. Even though the two of those could be separated, you have companies that explore for oil deposits. Oil and natural gas, they are sort of joint products produced more or less at the same time. There are companies that do just drilling. There are companies that do oil field services. There's companies that do testing. There are companies that do consulting. There are companies that do pipelines to move the crude oil. I mean, there are all kinds of different elements of oil and gas accounting. And so in this case, we're really talking about the exploration and what we do with them. And under a method called successful efforts, what you're going to do is you're going to expense things in that particular year, everything but what is successful and what we call a proven reserve, and we'll show the journal entry for that. Otherwise, the full cost method is we capitalize all of it, including the costs of those unproductive wells that are drilled. And it is the case that's you drill holes in the ground, you don't always get any sort of payback, and that's just part of the risks of exploration, and that's the way it goes when it comes to drilling for oil, which is why a lot of companies want to drill in areas that are known to be gigantic proven reserves, like the Permian Basin, the Bakken shale, drilling areas and all this. And so you kind of get the idea that it would make sense to drill where you have a pretty good idea there's oil. So under the successful efforts method, you've got exploration expenses, which are simply expensed, and the only thing that is capitalized is the oil deposit. That's an asset. The exploration expense is an expense. Both debit balances and the cash to offset that is the credit. Full cost method, it all goes into the asset side of the equation, and then you've got depletion that comes out of that over time. And I think we talked a little bit about depletion earlier, but again, there are a lot of different topics on this, and if I would say too, if you're going to go into public accounting in this part of the country, it would probably be a good idea to get a little bit up to speed on some of the peculiarities of oil and gas accounting. It's a little bit different. We certainly saw it in the tax practice, where we have people who had some connection, even passive investors, some connection to oil and gas, and so you kind of have to. It'd be nice, particularly in the public accounting field, to be able to talk to clients about what's happening, so you can, be able to speak the same language. So, all right, Jill Oil, this quick one well is done here. Jill Oil Company incurred $2 million in exploration costs for 10 wells drilled in 2021 in West Texas. 8 of the 10 wells were dry holes. Under the full cost method, we're going to debit what? We're going to debit $2 million, right? Or, I'm sorry, $20 million. Let's see. Oh, it was 2 million times 10 wells. Okay, that's what it is. I knew it was. There's no $2 million answer there. It's 2 million per well times 10 is going to be 20 million, and we're going to simply debit all to exploration expense under this particular full cost method. Okay. All right. So, any questions about this? You can feel free to get with me, and I think this is all we are going to cover here. So. If you have questions, feel free to contact me. I'm more than glad to discuss anything that we've covered here in Chapter 10 or any other thing. And good luck with the work for Chapter 10 for this week. And as we come back on Tuesday next week, we're going to get into the next chapter, which is we're still moving our way down throughout the balance sheet here. I'm going to talk a little bit more about some other areas with regard to the balance sheet, and that's essentially what we're going to be covering throughout the rest of the term here. Okay. All right. Have a great weekend. See you next time.